Welcome to Mathematical Finance. Today we are diving into a fascinating and crucial topic, bounds on option prices. Imagine buying a ticket that lets you purchase a car for a fixed price. How much should that ticket cost? While we might not know the exact fair price, we definitely know some absolute limits. In financial markets, these limits are called bounds. Understanding these bounds is essential because they keep the market rational and prevent magical scenarios where traders can make free money with zero risk. Let us explore how these mathematical guardrails work. Before we look at any equations, let us understand why bounds matter. In mathematical finance, bounds on option prices refer to the strict mathematical limits within which the price of a call or put option must stay. A call option gives you the right to buy an asset, while a put option gives you the right to sell it. But why do these limits exist? They exist because we assume financial markets are free of arbitrage. Arbitrage is essentially a loophole that allows someone to make a guaranteed risk-free profit out of thin air. If an option's price goes above its upper bound or below its lower bound, traders will instantly exploit this. They will buy the cheap asset and sell the expensive one. This massive buying and selling pressure quickly forces the price back within the bounds. Now that we understand what bounds are and why they exist to prevent arbitrage, let us look at how they work, starting with the absolute maximum price an option can have. This is known as the upper bound. Think about a call option, which gives you the right to buy a stock. Logically, this right can never be worth more than the stock itself. If a stock is trading at $50, a rational person would never pay $51 for a contract that merely gives them the right to buy that stock. You would just buy the stock directly. Therefore, the current stock price acts as an absolute ceiling for the call option price. No matter what happens in the market, the call option's value is capped by the value of the underlying asset. This logical ceiling we just discussed can be written as a very simple mathematical formula. The formula states that C must be less than or equal to S0. Let us break down these symbols. The letter C represents the price of a European call option. Remember, a European option can only be exercised on its exact expiration date. The symbol S0 represents the current spot price, which is simply the price of the stock today in the market. Conceptually, this formula guarantees that the option price stays rational. If the stock price S0 increases, the maximum possible ceiling for the call option price also increases. If the stock price drops, the ceiling drops with it. If C ever exceeded S0, an arbitrager would sell the option, buy the stock, and lock in an immediate risk-free profit. We have seen the ceiling for a call option, but what about a put option? A put option gives you the right to sell a stock for a fixed strike price. The maximum possible payout for a put option happens in the extreme scenario where the stock price drops all the way to zero. In that case, you sell a worthless stock for the strike price, making the strike price your maximum possible gain. However, because a European put option forces you to wait until the expiration date to actually get this money, its maximum value today is not the full strike price. Instead, it is the present value of that strike price. We calculate this present value by shrinking the future amount using the risk-free interest rate, which is the guaranteed interest rate you could earn by putting your money in a bank. This brings us to the mathematical formula for the upper bound of a put option. The formula is P is less than or equal to K times e to the power of negative RT. Here, P is the price of the European put option today. The symbol K is the strike price, which is the maximum future payout. The letter R is the risk-free interest rate, and T is the time to maturity measured in years. The term e to the power of negative RT is a mathematical discount factor. It uses continuous compounding to shrink the future money down to its value today. If the interest rate R increases or if the time to maturity T increases, the present value shrinks further. This means the upper bound for the put option becomes lower as interest rates rise or time extends. We have established the maximum prices or upper bounds for both calls and puts. Now we must find the absolute minimum price or lower bound for a European call option on a stock that pays no dividends. Why do we need a minimum price? The lower bound ensures that the option's price properly reflects its built-in intrinsic value and the time value of money. It acts as a mathematical floor. If the actual price of the option ever drops below this floor, it means the option is too cheap. A smart trader could buy the underpriced option, sell the stock, and guarantee a risk-free profit. Furthermore, because an option gives you a choice rather than an obligation, its price can never be negative. The worst-case scenario is that the option is simply worth zero. Let us look at the mathematical formula that defines this flow. The final lower bound formula for a European call option is C must be greater than or equal to the maximum of S0 minus K times e to the power of negative RT or 0. This formula says the call price C must be greater than or equal to the current stock price S0 minus the present value of the strike price or 0, whichever is larger. Conceptually, this represents the minimum value the option must hold today to prevent arbitrage. If the current stock price S0 goes up, the lower bound goes up, meaning the minimum price of the option increases. Conversely, if the strike price K goes up, the subtracted term becomes larger and the lower bound goes down. Before we apply this formula, let us visualize what this lower bound looks like on a graph. On the horizontal axis, we have the current stock price, and on the vertical axis, we have the call option price. The dashed line represents our mathematical floor, the lower bound we just discussed. Notice how it starts at the present value of the strike price on the horizontal axis. The solid curve represents the actual price of the call option in the market. As you can see, the solid curve is forced to stay above the dashed line at all times. The red shaded area below the dashed line is the arbitrage zone. If the option price ever dipped into this red area, it would trigger an immediate arbitrage opportunity, and traders would buy it up until the price returned above the dashed line. Now that we have seen the formula and its graph, let us test it with a real-world scenario. We are given a stock currently trading at $50. So S0 is 50. The strike price, K, is $45. The option expires in 6 months, which is 0.5 years. So T is 0.5. The risk-free interest rate R is 5% per year, or 0.05. You observe this call option trading in the market for exactly $4. We need to find out if this price is mathematically allowed or if it breaks the lower bound rule. To solve this, we will calculate the absolute minimum price this option is allowed to have using our lower bound formula, setting up the equation to find the minimum boundary. Continuing with our calculation, we substitute the given numbers into the variables. We get 50 minus 45 times e to the power of negative 0.05 times 0.5. Next, we multiply the interest rate by the time in the exponent to find the total discount factor, which gives us e to the power of negative 0.025. Using a calculator, this exponential term is approximately 0.9753. Multiplying the strike price of 45 by this decimal gives an exact present value of $43.89. Finally, we subtract this from the $50 stock price. The math tells us the absolute minimum price for this call option is $6.11. However, the market price is only $4. Because 4 is less than 6.11, the price has broken the lower bound, creating a massive arbitrage opportunity. We just used the lower bound formula to find an arbitrage opportunity. But where does this formula actually come from? To prove this, we will set up a race between two different investment portfolios. We start by defining them today. Portfolio A consists of one European call option plus a pile of cash. We specifically choose the cash amount to be exactly the present value of the strike price, which is K times e to the power of negative RT. So the total value of portfolio A today is the call option price, C, plus that cash amount. We put this cash in a risk-free bank account, so it will grow over time. Portfolio B is much simpler. It consists of just one share of the stock. Therefore, the value of portfolio B today is simply the current stock price, S0. Now, let us fast forward time to the expiration date, which we call time T. At time T, the cash we put in the bank for portfolio A has grown with interest to become exactly K, the strike price. The call option will be worth either the final stock price minus the strike price or 0, whichever is higher. We write this mathematically as a maximum function. If we add the cash K to both parts of this maximum function, the total value of portfolio A simplifies beautifully to the maximum of either the final stock price ST or the cash K. Meanwhile, portfolio B is just the stock, so its value at maturity is simply the final stock price ST. We are now ready to compare the two portfolios at the end of the time period. Let us compare the two portfolios at maturity. Portfolio A is worth either ST or K, whichever is bigger. Portfolio B is only worth ST. Therefore, portfolio A will always be worth at least as much as portfolio B and sometimes even more if K is larger than ST. Because portfolio A is guaranteed to be worth the same or more than portfolio B in the future, it must cost the same or more than portfolio B today. If it did not, an investor could buy the cheaper portfolio A, sell the expensive portfolio B, and lock in a guaranteed risk-free profit. This logic means the value of A today must be greater than or equal to B today. Substituting our initial equations, we get C plus the discounted cash is greater than or equal to S0, which perfectly proves our lower bound formula. Having proven the lower bound for a call option, we can apply similar logic to find the lower bound for a put option. The lower bound formula for a European put option is the exact reverse of the call option logic. The formula for the minimum boundary is P min equals K times e to the power of negative RT minus S0. In plain English, the minimum price is the present value of the strike price minus the current stock price. Here, P-min is the absolute minimum price the put option can trade for. If the strike price K increases, the present value increases, pushing the minimum price higher. Conversely, if the current stock price S0 increases, the subtracted term is larger and the lower bound for the put option decreases. Let us test this new formula with a put option example. We are given a stock currently priced at $38. So S0 is 38. The strike price K is $40. The option expires in 3 months, which is 0.25 years. So T is 0.25. The risk-free interest rate R is 10% per year or 0.10. The put option is currently trading in the market for exactly $1. We need to determine if this price violates the lower bound for a put option. To do this, we will substitute our specific numbers into the minimum boundary equation we just learned, setting up the calculation to find the absolute floor price. Continuing the calculation, we substitute the values to get 40 times e raised to the power of negative 0.10 times 0.25 minus 38. First, we multiply the interest rate by the time to get negative 0.025 in the exponent. We calculate this exponential term, which again is approximately 0.9753. Multiplying the strike price of 40 by this discount factor gives a present value of $39.01. Finally, we subtract the current stock price of $38. The absolute minimum price for this put option is $1.01. Since the option is trading at $1, it is priced below the lower bound by exactly 1 cent. Even this tiny violation means arbitrage is possible, guaranteeing a small but entirely risk-free profit. We have seen how to calculate these bounds and spot arbitrage. But why do these mathematical boundaries matter so much in practice? In real-world trading, high-frequency computer algorithms constantly scan the market for options that violate these bounds. If a bank's computer sees a call option priced even a fraction of a cent below its lower bound, it will execute a trade in milliseconds to capture the risk-free profit. This constant scanning and trading is exactly what keeps the market efficient and fair for everyone else. Without these mathematical boundaries acting as guardrails, option prices would be completely random and disconnected from the actual stock prices. Companies and everyday investors rely on these bounds to ensure they are paying fair prices when they use options to protect their portfolios against market crashes. To summarize our journey through mathematical finance today, bounds on option prices are the absolute maximum and minimum values an option can hold in a rational market. We learned that upper bounds prevent an option from costing more than the underlying asset itself or its maximum possible payout. Lower bounds are equally important, ensuring that the option's price properly reflects its built-in intrinsic value and the time value of money. Most importantly, we saw that if these mathematical rules are ever broken, traders can immediately step in to make guaranteed risk-free profits. This buying and selling pressure is the invisible hand that forces prices back into line. You now have a solid understanding of the mathematical guardrails that keep financial markets functioning properly.